Redwood Logistics is one of the nation's fastest-growing logistics providers, fueled by industry-leading technology and a passionate team of experts. From multimodal brokerage and dedicated truckload to third-party logistics and TMS consulting, implementation, and integration, Redwood Logistics delivers next-generation solutions for its clients and much more than a truckload.
Weekly market update. Capacity abounds as volume flattens. Inflation pressure cools, but trucking rates keep climbing in December. Carriers roughed up as shippers, brokers search for freight market bottom. U.S. Supreme Court rules in favor of driver in dispute with new prime. Ford, Volkswagen announced partnership to jointly develop commercial vans and pickups. And Volkswagen announces a Chattanooga plant expansion with a focus on electric vehicles. I'm JP.
And I'm Chad.
And we discuss all these issues and more on this week's episode of What the Truck. Hey, Zach!
Yeah, and we're joined by Zach Strickland.
I was all ready to say it, and you just cut me right off.
Sultan of Sonar, market expert extraordinaire, Zach Strickland.
And, this is episode 50. That's 50. And it's,
Nifty 50.
After 50 times, Zach, we become set in our ways. And so sorry for cutting you off. But it's great to include you and have you here.
No, it's great. Great to be here on 50. I was on 9, I think.
Come a long way.
Actually, I think you were on maybe 47 or 8 as well. You were a very recent contributor, and we love having you on, and especially for your market analysis, and not only for your good looks. That nobody can see that.
But,
on the podcast.
but more importantly,
wonderful sense of humor.
More importantly, what are you sipping on, Zach?
I am sipping on Naked River Brewing Open the Hop Hatch.
Ooh, open the hop.
Ooh, you want to share?
I think you got the hazy, man.
I had it last week, and it was delicious. I had to get more. I don't know how long they're going to have it, so I got to take advantage.
And Chad?
Well, I was about to have a brown sugar, but I've changed my mind. Thanks for sharing, Zach.
Yeah, have at it. These guys are right next door to us.
And I am sticking with my comfort beer. Back, after last week's debacle with trying to drink tap water and then failing miserably at Big Deal, Little Deal, I've decided to go back to what works, Bell's Two Hearted. All right.
It's good to have you back.
Bell's Two Hearted. Oh, and Zach's
yeah. Well, no, it's good to have you back, JP, drinking beer again. That was the very first time to ever drink water on the podcast.
And it sucked.
Well, I'm sorry that it was such a bad experience. But anyway, here we are, and one of the new things that we're trying to do is, besides just giving you the headlines of the week, we want to also have kind of a unique angle where we're bringing, for our listeners, kind of a market playbook of what to be looking at, what we've been experiencing so far in the most up-to-date data that we can imagine possible, but also your playbook literally as you head into the next week.
Yeah, so those first 3 headlines that we read, the weekly market update with capacity abounding as volume flattens, the inflation pressure cools, but trucking rates kept climbing in December, and carriers roughed up as shippers and brokers search for the freight market bottom. That's all sort of, what we think of as stories that characterize the freight market.
And then we hit our...
And then we'll hit our normal sort of headlines, what's happening in automotive, what's happening Supreme Court, that kind of stuff.
And not to disappoint, we will continue to bring you Big Deal, Little Deal, and this time we're going to make it happen. I promise. Well, I can't make any promises I can't keep, I guess. But Zach, you wrote the very opening headline of the weekly market update, and what do you mean it's monsoon season for capacity?
So essentially, we've come into this time of year. January is traditionally kind of like the slow season for freight.
Right.
January slows down, but we opened up the year with an unusually strong volume number. And, that typically means that capacity kind of goes away. Well, capacity is...
Like in January of 2018.
Yeah. January 2018, they had an extended holiday season, if you will, where capacity was still dried up, and it was due to anomalous volumes coming into the market. Well, we're actually experiencing volume...
and capacity wasn't ready.
Right.
As they
exactly
seem to be this year.
Again, carriers had just come off of a slow period of time. They hadn't been purchasing trucks all year like they have this year. They didn't have the revenue to kind of invest in the building their infrastructure out,
Right.
as they have literally all 2018.
In fact, yeah. Well, I didn't mean to cut you off there, but is it true that are we at historically low levels of tender rejections?
Yeah, the tender rejection index it's hit like a new low. Like
So far
every
as we've
single
charted it.
day this week.
We're
We're in like 8.4% territory, which is as low as it's been ever.
And I think actually, JP, it's an article that you wrote in a part of this Market Playbook of the carriers roughed up as shippers and brokers search for the freight market bottom. You have a couple of strong reasons and I feel like it's important to go ahead and kind of note the how or the why this is happening.
Yeah, I mean, capacity has been fairly loose for some time now. I think we could say even going back into December, November. But, one of the common, often repeated adages in the trucking industry is that the shippers are the last to know what's happening in the freight market. Well, now they know what's happening in the freight market. And so they are being aggressive in issuing their RFPs. They are issuing, I talked to a brokerage in Chicago that had quoted 3,500 lanes. And they said that the average sort of round two or the average counter offer that they got back from the shipper was 25% lower than what they bid. So, I think the shippers are kind of trying to take the reins, push things down, and the brokers are following suit and they're chasing rates all the way down to the bottom. It's really, it's if you think of trucking capacity as a commodity, there's no real bad day in the market. What's bad for someone is always good for someone else. Right now, shippers are able to save a lot of money. Shippers are moving goods very easily, very cheaply. That will probably end up holding inflation down for the consumer, things like that.
And one of the things I thought that was interesting that you just laid out was that you've just kind of laid down the gauntlet and said that the capacity constrained environment of the past 18 months is over.
Yeah,
and one of the reasons you mentioned, of course, we've seen all of these record-breaking orders of truck orders.
We've seen that. We've seen double-digit driver wage increases,
which is a good thing. And you know what that led me to wonder about?
And that's not going to go away, which that's good.
That's
so
great.
Even though tender rejections have gone down, I think that the wage increases, basically have pushed the floor up a little bit.
Yeah, no, right? I think Ibrahim kind of wrote about the increase in trucking rates, over-the-road trucking rates, still going up economically speaking in the macro sense.
And that's December numbers.
December numbers, exactly.
Yeah, that's all we have.
And they actually are up still year over year. If you look at some of the spot market pricing, we're still at levels like 20 to 30% higher than we were this time last year. So the market has adapted its pricing structure already. So the shippers are essentially coming in and trying to, it's kind of a reversal to the mean, kind of going back to the norm. To get a 25-30% rate increase in a year is unheard of.
Yeah.
That is, it's also unsustainable. So,
we've been talking a little bit about that over the past, week. Right now it seems like rates are going to go down. It's predicted in the first.
They're spiraling down quickly.
But who knows? Well,
like our initial report. Just to give you an example, our initial report. From DAT, which it's kind of complicated to explain, but essentially it's reports as they're not final, but it's over the past five business days.
Okay.
From yesterday until today, rates from Chicago to Atlanta, exclusive of fuel surcharge, fell from $2.27 a mile to $2.01 a mile in a day. So we're actually in a quite volatile moment.
Extremely volatile.
Of which brokers are taking advantage of.
Yeah.
And shippers.
Shippers are driving the bus now, and brokers are kind of along for the ride. They're doing very well because there's plenty of volume, and they're getting fat margins.
And brokers kind of grew up in this kind of environment. They didn't, in 2009, 2010, when the rates were actually compressing significantly, that's when brokers had their big boom. Yeah. That's when they started really coming onto the scene. So this is kind of natural territory for them.
Yeah, this is their happy place. They the fall peaks, the summer peak and the fall peak of 2018, actually they saw negative margins, right? Because spot rates were outrunning, basically the carriers were in control in driving prices up faster than they could get the shippers on board.
Yeah, no, it's too hard to keep up when the market's inflating like that. When it's cooling off, you have that kind of leeway because you can always get a truck.
I have to say that's interesting. I think several months ago, but while like things were super hot and we were all time, and we were saying, oh, is this the new norm? Will the pendulum really continue to swing back and forth such as it has historically? And we were like, the pendulum may not swing. The capacity may kind of remain tight. Well, the pendulum is swinging and the ball is in the shipper's court.
Shame on us for saying that.
No,
I mean, there may be more visibility and transparency, but the pendulum swings.
No, I think it's just the old adage. I mean, what goes up must come down.
Yeah.
And the converse is also true. We're not going to live in this world forever, just like we're not going to live in that June overheated market forever.
Right, but as you said, like the driver wages and the ELD have created have raised the floor, I think, a little bit.
No, I agree, and I think that the last couple of years have actually injected energy into the transportation space that hadn't been there before. So just like the potential energy is now there for it to continuously be in this like pendulum swinging motion.
Well, a curious thought, and I'm just throwing this out there, but what are the? I mean, and I don't know that we can answer it, but what are the implications to this driver shortage issue? You know what I mean? Like if capacity is abounding and driver wages are super high, like I mean, how is it the same? Is it the same issue that it was?
The driver shortage is an ATA meme about the difficulty of seating over-the-road drivers for the large carriers face.
It's very difficult because these guys, you have to do background checks on them. None of these guys want to drive for a big company. They don't want Big Brother watching them. Eventually, once they get trained up or they're able to, kind of be off on their own, that's exactly what they'll go do. Or they'll work for a small carrier where they know the dispatcher, like personally. It's not going to be somebody that kind of rotates in and out of the, somebody that's talking to them 2,000 miles away.
And this is an industry with a massive number of recruiters that are trying to pull people in, and the average person is not suited for this kind of job,
right?
And so they're not happy doing it, and so there's going to be a lot of churn. I mean,
there just is.
Yeah, and but I think in terms of in 2018, when the Wall Street Journal was writing about how corporate earnings were getting hit by the driver shortage and inflated transportation costs, I think we're past that moment. Mm-hmm. I mean, I think the mega carriers are still going to have to churn as many people as they always have, but capacity and demand are swinging back in the other direction.
Not in balance.
Well, to ask another question, we're saying that we've talked a lot about shippers and brokers here. What are the carriers trying to do right now? Are they trying to renegotiate rates?
No. They're trying to hold on to the rates.
Yeah.
They're trying to hold on to their contract rates.
Absolutely.
Oh, they're trying to hold on to them, but they're not getting any.
The shippers are asking for decreases.
This is kind of
So what are the carriers doing?
They're
trying to hold forth?
Yeah, they try to hold the service because once they break service, then the shipper can go to them and say, "Hey, your service isn't great. We're gonna, look elsewhere if you can't service our freight," and they'll have a multitude of options. So,
but I guess my question is, if they are going, if the shippers are going to the spot market and finding the cheap freight, then is there a response right now that the carriers are trying to have?
I mean, the carriers need to talk about the long-term relationship because that's essentially what damaged the shippers last year.
Yeah.
It's like, look, you guys bail on me and have been beating me up for 5 years.
Right.
And now I finally have some leverage in this space.
Right.
And the shippers found themselves in uncharted territory for the first time in a very long time where they couldn't find trucks.
Right.
And so the carriers kind of were like, look, this is going to happen. And the shippers were kind of like, yeah, I guess it's your turn.
Right. I think, more broadly speaking, the strategy, if carriers they're looking for asset utilization. They need to keep their trucks moving. The price, matters less at this point.
Right.
They're not. January is not typically a time when they're looking to, make profits. What they're trying to do is cover their fixed costs.
They just want to make it through January, February, essentially.
Yeah, until produce season starts.
Historically speaking, as well, right?
Yeah.
I mean,
exactly. That's exactly right.
Okay, well, what about Ibrahim's piece on in the good news is inflation pressure is cooled so far as our December information is telling us. But it looks like there's a very strong likelihood that the Fed may not raise interest rates one or even two times. What you're saying, JP? You think maybe once?
I think the bond market is pricing in no rates, but a lot of people are saying it'll probably happen once.
They need to build. They need to build it up a little bit so they have a little bit of ammunition left in the tank if they need to give the economy a little bit of a boost or a kick.
Yeah, but it's great, honestly, that we don't have a lot of inflation. I mean, you can talk about it however you want. I mean, it's not having a lot of inflation implies a strong dollar, which means that it's hard. It hurts our exports, for example. It helps us buy things more cheaply, which probably helps the freight economy.
No, the currency markets are crazy. I mean, it's hard to really kind of concisely explain the impacts of inflation and deflation. God willing, hopefully none of that happens. But a moderate pace of inflation is exactly what you want. You don't want it to obviously go off the charts.
You don't want it to go negative either. But you want people to spend money. You want people to be incentivized to, banks, anyone who has a lot of cash. You want them to be incentivized to get it out of their bank account and put it to work.
Right. And thinking about that in terms of the freight market, the price increases that we saw last year were not good inflation. In the long run.
It's as he said, or he observed was it just seemed like just very recently we were still worried that we were overheating. We were in an overheated market and things were spiraling out of control.
Third quarter of 2018, the GDP grew above 4%. I mean, that's
possibly wasn't very healthy.
No, that's a short-term benefit to essentially the carriers and brokers out there that isn't sustainable, and it hurts them in the long run. That's probably why we're seeing this kind of cratering effect right now, is because it has essentially cratered on them.
Yeah. Have you ever gone out, with your buddies and gotten really excited and had maybe a little too much fun?
Nope.
That's a terrible idea.
And then the next day, it's kind of even worse than it normally would have been.
Well, that's a kind of an interesting analogy, JP.
It's not a coincidence that they call they refer to the January hangover in freight, especially with regard to all the freight that was pulled forward. It's. You can if you assume a sort of a normal constant average of freight activity, and then external forces bunch it all up into one period, well, that means there's going to be less in another period.
Exactly. No, that's exactly what's happened.
You're allowed to have a finite amount of fun.
Exactly. Good captain.
You can't constantly expand. There is no ever-expanding economy, even though there may be an ever-expanding universe. Okay, well, we had some other very significant headlines. This week, not the least of which was the Supreme Court ruling in favor of workers. I mean, a Supreme Court that seemed like it might be tipping in the balance of corporate interests across the board. Jay, do you want to give us some background on just kind of the ruling and what was at stake and what was going on?
Sure. So the ruling was New Prime. The case was New Prime versus Oliveira, and it was basically a guy, an owner-operator type, who was working for New Prime as a contractor.
All the way back in 2013, it began
as an independent contractor. And, he didn't like the way he was being treated. He quit. He sued them, but basically he had an arbitration clause in his contract forced them to arbitrate, and this is kind of what was at issue is, and it gets really complicated. I would recommend everyone read the FreightWaves Now video from...
Or watch the FreightWaves Now video from Wednesday. From Wednesday, because we have some general counsel, Kevin Martin, kind of gave us the down low of that.
Our lawyer explained the whole case. But essentially what it is, it has to do with New Prime basically misclassifying its employees who are, of course, are under forced dispatch and working under New Prime's authority, yada yada yada, not true independent contractors. Right. Misclassifying them as independent contractors in order to force them into arbitration, instead of allowing them to actually sue. So if they violated the Fair Labor Standards Act, they could kind of hide in this arbitration court and take care of all of their disgruntled employees kind of one-on-one without ever allowing them to get any momentum in court. Now, what this opens up is basically I can sue New Prime if they treated me poorly, and now I can ask to get certified as a class of employee. I can say, okay, there's all these other people who are just like me who were mistreated and underpaid under the same policies. We can all band together now and really sort of seek justice in the court system.
Yeah, mm-hmm. the way I understood it, and that's it's kind of complicated to understand, but the way I kind of understood it in its simplest form, and correct me if I'm off base here, talking to our lawyer, was essentially the single employee has very little power in the arbitration situation, and they don't have the funds to kind of push forward with that process because the lawyers are going to say it's not worth my time to represent you in this situation because they're not.
If you worked for New Prime for 6 months and you got screwed out of $15,000 and the lawyer's looking at a third of that, if he recovers, it's $5,000, but he might not get anything if he loses. It's not really worth it. But if you got 500 people,
so now the class action actually makes it worth his time, which now is made legal, essentially.
And essentially, like if we were really to boil this down, it's according to our chief legal officer, Kevin Martin. It's not a blockbuster ruling. It is a major ruling. It's significant, but it only pertains to the ability to either arbitrate or not. And that is where some of it becomes like hard to, a little bit difficult to parse out in a succinct way.
Right. It's complicated. I mean, it's a Supreme Court opinion, right? So it's if you want to go to SCOTUS blog, if you want to watch the video, like it takes a while to understand. One of the things that the decision does not say, for example, is that there's no such thing as independent contractors. It kind of says, if you're misclassifying independent contractors or employees as independent contractors, you can't force them into arbitration. There's still, there could be a company out there that actually sort of, maintains a legal separation and actually treats independent contractors the way that independent contractors should be treated, treats employees the way they should be treated, et cetera. This decision won't affect them. Those independent contractors might still, be subject to arbitration.
A couple of things that are interesting to note about it. It was a unanimous, if you can believe that, it was a unanimous Supreme Court decision, which is, fascinating to think about and unfold unto itself. How conservatives, on the one hand, could interpret a 1925 law, by the letter of the law, while liberals, kind of interpreting it in the living, breathing, interpretation of the law as well.
Yeah, it was a conservative technique that produced a liberal outcome, if you want to call it that, and so everybody jumped on board. Kavanaugh wasn't on the bench.
It was an 8-0 decision.
Right, it was 8-0. So Kavanaugh wasn't on the bench when they did the oral argument, so he didn't vote. But
So the ability, the arbitrate means it's one at a time, and now they can do class action. And as our counsel said, it's really only bad news to the people who were not playing by the rules in the first place.
Right.
But he also talked about the potential for frivolous class action lawsuits, because he says essentially, talks about this in the video. Once you get certified as a class, and once the potential for hundreds of people to join the lawsuit, emerges and is a thing. The cost of litigation goes up exponentially, and therefore he said really the battle is, are you a class or not? And the example he gave was like, the company, it's called New Prime, will say, oh well, you worked for us from May to June. This other person you're saying is part of your class worked from July to October. That's completely different. They were driving, they were based in San Francisco, you're based in San Diego. It's completely different. You can't lump those people together. They're not in the same class. Well, once you convince the judge that, it's the same class, then essentially you've won, and then the settlement proceeding, the negotiations start.
I think it'll be interesting to see just what this does to the dynamic of the bigger carrier who has, a percentage of owner-operators. All of them have a certain percentage of owner-operators. I think right now it looks around 15 to 17% of a lot of the carriers have owner-operators.
Across the industry,
Yes,
17% of the big fleets are made up of owner-operators.
Owner-operators, correct, yeah.
Yeah. Okay. The other two headlines are somewhat related that we thought were big deals this week. First, Ford and Volkswagen announced a partnership to jointly develop commercial vans and pickups. Kind of a big deal. I mean, cats and dogs getting in bed together, and then also Volkswagen announcing a Chattanooga plant expansion with a focus on electric vehicles. Why don't we take these on together, guys? What do you think? Like, what's going on with in the macro view? Why? What are the advantages? What's cool about Ford and Volkswagen getting together? Like, what's their strategery here?
I think probably the biggest thing, especially with the electric/autonomous kind of market, is that these guys can kind of share the risk, because this is an undeveloped, this is a totally undeveloped
that's what it's about,
technology. So they for them to dedicate an entire infrastructure or setup to an electric or autonomous, which I think electric's fine, but autonomous vehicles.
Well, the issue with electric is they don't want to be competing with each other over the metals needed for the electric supply chain.
Exactly.
Interesting.
But also, there's a little bit.
They want that market to be rational.
But they also have a little bit of branding here, where they're kind of.
Yeah, they're both the common person vehicle.
So, Volkswagen has this market share that doesn't compete with Ford's biggest product, which is the pickup truck and the trucks. So they're kind of
yes, and they're
Ford
sharing
is kind
that.
Of, Ford's kind of saying, hey, we've got this truck market and this brand and image. We're going to help you guys out with that.
Right.
And Volkswagen has this presence in Europe and all this kind of stuff that they're going to basically say, we'll help you out there. So it's a pretty good deal, I think. It's an interesting setup to see the two big automakers kind of joining forces.
Someone interestingly said that this is their attempt at competing with Tesla of all companies, which I find strange, but possibly true.
I don't know if they think of Tesla as their competitor. I don't think that, for example, Ford thinks
they don't have anywhere near the
Infinity
market
as
share.
its competitor.
No.
But they're also middle class vehicles. None of my friends drive Teslas.
No.
I'm not. Maybe just because I'm not that rich. I don't know.
A Tesla's.
When
you said, kind of a high end.
Most people I know don't drive $70,000 cars.
When I see one on the highway, I want to stay behind it and kind of check it out, because it's that rare of an occurrence. But so we've long since, or for the past several weeks, noted that Ford has their CEO, is it Jim Hackett, he said that they're getting out of the sedan game and they're going in the SUV and truck game. And
That makes sense. They need money to develop electric and develop autonomous, so they're getting rid of their small, their thinnest margin vehicles.
But I mean, that's what Volkswagen is into as well. They're I mean, they're not getting out of the sedan game.
No, I mean they have a huge presence in Europe too, where the sedans are still dominating.
Well,
I mean,
people don't love pickup. Like if you go to Paris, even if you go to like rural France, you're not going to see lots of pickups driving around.
They don't have an abundance of space like we do here in America.
Well, it's also just a completely different like car culture. These are cities that were built for trains.
Right.
Passenger trains.
Well, their infrastructure is set up for a very compact. I mean, they've been around for centuries.
Right. Try to drive. Try to drive like a Ford Expedition through medieval Toledo.
Yeah, I mean, Florence is dominated by scooters, for instance, for a very good reason.
Exactly.
But even driving around these the antiquated sort of like Tennessee highways and byways with my Ford F-150. I didn't dig it. I have to admit, I didn't dig it, and after 5 years, I gave it up. I don't know. And I mean, in trying to drive in downtown Atlanta traffic and park in those underground parking lots, I didn't enjoy it.
You gave me a little bit of heartburn just now.
Just right now.
Just talking about it, I was a little.
Well, I'm sorry about that.
You gave me some anxiety.
Well, you're feeling the anxiety.
But we both drive like crossover SUVs.
Yeah, I mean, I have
you have a kid,
Nissan Rogue, I have to admit.
You have a kid.
Yeah.
All of a sudden, it's like, wow, how do they have so much stuff?
Anyway, So, what's also interesting is, Volkswagen, expanding their plant, focusing on EVs, which I think is super cool, and it's happening right here in Chattanooga.
That's very cool. It's a great investment into the city. There's hundreds of millions of dollars, hundreds of jobs. I imagine it's not just like adding another production line and getting a bunch of assembly workers. Like this is an entirely different technology base, and so I imagine like engineers and different kinds of technical managers, people like that coming in as well.
I'm still a little bit unsure how this kind of coordination works, though. Like functionally, like when I think about Ford and Volkswagen like making cars, like do they share like the process? Because that seems like it would be a very tough thing to do.
I don't think they have hybrid plants.
Yeah.
I think they focus on, each company kind of focuses on what it's good at, and then they share those components across.
Well, here's the kind of downer about the news is that, they got to make plans, but it's not really coming to fruition until 2022, 2023, guys. On the
so they've got a lot to figure out.
But in the short term, what is actually more compelling about the EVs for Volkswagen is that in a year and a half from now, by 2020, Volkswagen wants to sell 150,000 electric vehicles. And if that sounds like a lot, which I don't know if it does to you or not, but five years later, by 2025. They plan on killing that number, and they plan on reaching 1 million.
Wow. That's like totally changing their whole...
That's a massive...
Yeah. It's the beginning.
And was it GM that said that they wanted like all of their models to be electric by like 2025? Something like that? Something crazy like that?
I thought they abandoned that.
Well, I don't know. I mean, as far as it sounds to me like with EVs, it's all happening, as they say in Almost Famous.
We'll see. I mean, over the next, this year, next year, we'll see how much progress they make. But I mean, it's what the industry is saying is that there will be like a fundamental transformation of energy consumption, of the way that cars are built, of the materials that go into cars, of the way that people drive them and fuel them and use them. I mean, we'll see what this looks like.
And then lithium will become the new crude.
Right.
Lithium. It's not just a drug.
And whatever it is that
to keep you calm.
Fueling the power plants that are charging these cars. Right.
Right.
And now for our 5 good minutes, we are visited by Steve Gattaletta, SVP of Sales at Redwood Logistics. Steve, great to have you on.
Thanks, Chad. Hi, JP. How are you today?
Doing great. Thanks for making time for us.
We are so excited to have you on. Thanks for spending some good minutes with us. Are you ready to run the gauntlet of our incisive questions?
As ready as I can be.
All right. Well, ready or not, here we go. Take it away.
Steve, what has pushed third-party logistics providers toward adopting a fully integrated model instead of just focusing on niche services like they have in the past?
Great question, JP. I've always found that the market always drives demand, and it's really no different in this case. Over the last year, with the impact of the economy, the challenges with the driver shortages, hours of service, and such, a new level of efficiency has really been required to navigate the shipping environment, and that just can't be realized with a singular or a niche approach.
Right, absolutely. How have customers communicated to you about the need for this full service kind of solution approach?
We're pretty fortunate. We've had the opportunity to collaborate with our customers. They've given us that opportunity based on the trust we've built over the years. So when we visit with the customers, while they tend to express these things in different ways, they recognize business as usual is not going to meet their needs moving forward. They also share that their attempts at in their past approaches at singular changes in their supply chain, such as issuing an RFP or implementing a new TMS, is just not bringing the desired results that they're looking for. So, guys, I think what they're seeing is they understand that there's an interdependency between these various transportation components, and connecting and efficiently exchanging information between these is pivotal for them to operate effectively.
Makes sense.
And has offering the past 18 months in the market, super constrained capacity, that might be changing now, but I'm just interested in, are these this full service solution that you offer your customers, Steve, does that play a part in dealing with tight capacity?
Absolutely. It's really the only way to generate the efficiencies that's required in the marketplace. And the entire market, whether it's shippers or the transportation providers, all benefit from the holistic approach in dealing with what we saw last year from a capacity crunch standpoint. As you think about a competitive advantage in the past, a shipper having an integrated solution to approach shipping, or quite frankly, a third-party logistics company having that integrated solution to provide their customers may have been a competitive advantage. What we're seeing today is that it's absolutely a competitive necessity,
right,
to support what our customers are looking for.
And can you describe just a little bit about what the full service solution looks like? I mean, do you guys actually get into the internal operations of the distribution center? Is this about staging trailer pools to make things run a little bit better? What are the kinds of things that you offer these shippers?
That's great question. So we really break it down as we view a next generation freight management organization to provide services in 3 buckets or verticals, and we view it as move, manage, and knowledge. And from a move standpoint, you've got obviously LTL, parcel, intermodal, truckload, approaching that via asset-based as well as brokerage, and then from a managed standpoint, the versatility to set up processes that allow our customers to self-manage, co-manage with us, or turn the keys over and have an expectation that we fully manage your transportation. And then finally, from a knowledge standpoint, putting in the systems that connect and allow our customers to manage their business, take full advantage from a dynamic standpoint of mode optimization, route optimization, and develop the dashboards so they can ensure the execution of that on a real-time basis.
Hey, whoa, right there at the 5-minute mark, too. Steve, thank you so much for sharing some of your time with us and on the subject of full service integration and how it's basically a necessity and not just a competitive advantage.
Thanks, Chad. Thanks, JP. We appreciate it.
Awesome, man.
Thanks a lot, Steve.
Thank you. Wow, what a fantastic session it's been for episode 50, starring Zach Strickland, Sultan of Sonar. JP, let's see if we can manage to run down the rest of the 8 headlines in 2 minutes or under. Are you ready? Well, ready or not, here we come.
Okay.
Okay. Brexit deal is best route forward for freight industry, big deal or little deal?
It's a huge deal. Theresa May survived her confidence vote, and hopefully they can work out something to create some certainty for the business community.
Autobon AI wants to turn all trucks into autonomous trucks, big deal or little deal?
I think it's a little deal. This is an aftermarket solution, and it's only promising a level 2.
Another step in the comeback of Roadrunner, a mainstream analyst is following them again. Big deal or little deal?
It's a big deal. They've managed to consolidate 20 acquisitions into about 6 business units. Maybe the company will start making sense again.
Airbus announces 400 new jobs will build the A220 in Mobile. Big deal or little deal?
I think it's kind of a big deal. It's interesting that southern port cities are getting all of a sudden aerospace interest. Slowing wood demand reduces global trade of lumber. Big deal or little deal?
Little deal. While it signals a slowdown in housing construction, it's also coming off record highs, and it's still a robust number.
Evergreen adds megaships to its fleet. Big deal or little deal?
Little deal. While they're certainly enormous vessels, it's simply an increase in capacity.
Volvo finding early success with subscription-based car model. Big deal or little deal?
Big deal. I mean, people get to drive a new car without the long-term commitment of a loan or even a lease. There's a 15,000 mile a year allowance. There's no price negotiation. They're handled online. It's a cool new model. It's an awesome deal.
FedEx unit to pay $35.3 million to New York State to settle cigarette trafficking charges.
Easy for you to say. The amount of the settlement, it's a big deal because the amount of the settlement is far higher than the foregone tax revenue, as the state had said, and its size was warranted, though, given FedEx Ground was previously investigated for the same conduct, and its actions went on for years.
Boom! We got it.
We did it!
155. I feel like
somehow, some way.
I kind of outperformed it this time, I think.
I mean, episode 50, you guys should be awesome right now, right?
No, but we lost last time because I drank water.
Well, the pendulum swings back and forth, It's
just like the truck. We get fat and happy and complacent. We think we can just hammer it down every time, like always, and then all of a sudden
you lose your edge.
Well, I have to say too, guys, for episode 50 and for having 3 of us parlaying these complex array of headlines, we managed our time well, keeping it just lean and mean, I have to say. So to that, cheers.
Cheers. Well, thanks for listening to this week's episode, and thanks again to Redwood Logistics for helping us out and partnering with us on What the Truck.
As always, we go into more detail about each of the topics we've talked about today on our website, FreightWaves.com. We will continue to publish this podcast weekly, so be sure to subscribe to What the Truck on Apple Podcasts, Google Play, Stitcher, and SoundCloud. Also, make sure to leave us a review to let us know what you think of our new podcast. That'll do it for today. Thanks for tuning in, and we will see you next week on What the Truck.